In commodity markets, inventories are one of the most important and most misunderstood drivers of price behavior. Unlike financial assets, commodities can be stored, and the volume sitting in tanks, warehouses, silos, or cold storage reveals more about market balance than almost any other indicator. Inventories act as a buffer between supply and demand, absorbing shocks, moderating volatility, and shaping forward curves. If you want to understand why commodity prices move the way they do, start with stocks, their size, their accessibility, and their trajectory. At the most basic level, inventories represent the cushion the market has available. When stocks are high, the market can absorb supply disruptions or demand surges without major price dislocations. When stocks are low, even small disturbances can trigger outsized moves. This is why commodities with thin inventories, like cocoa or certain regional fuel markets, tend to experience sharper price reactions than commodities with deep, flexible stockpiles. But it's not just the level of inventories that matters. It's the rate of change. A market that is drawing inventories consistently, meaning consumption plus exports exceed production, signals tightening conditions. A market that is building stocks shows oversupply. Traders watch these trends closely because they reveal the underlying direction of the balance long before prices fully adjust. Inventory accessibility is equally important. Not all stocks are created equal. In metals, the difference between exchange warehouses and off-exchange storage can influence liquidity and price discovery. In oil, the location of inventories, Cushing, ARA, China, Fujairah, determines their usefulness in meeting regional demand. In agriculture, quality, moisture, content, and storage infrastructure all determine whether stocks are market-ready or effectively locked away. This leads to the concept of available inventories, which may be much smaller than headline stock figures suggest. When usable inventories shrink, markets can appear tight even when total stock numbers look adequate. Inventories also interact directly with forward curves. When inventories are high, markets often move into contango because the cost of holding excess supply needs to be compensated. When inventories are low, markets often shift into backwardation, reflecting the convenience yield, the premium for holding scarce physical supply today. This dynamic is especially visible in energy markets. When crude tanks fill, the curve steepens into contango. When tanks draw down rapidly, backwardation becomes more pronounced. Agricultural markets show similar behavior around harvest cycles, where seasonal stock building and drawdown create predictable curve rotations. Inventory transparency, or lack of it, adds another layer of complexity. Oil inventories in OECD countries are tracked closely and updated weekly. Metals inventories are partly transparent, but a growing share sits in private storage. Some agricultural producers provide frequent updates, while others offer limited visibility. This uneven transparency can introduce uncertainty, risk premia, and volatility as traders attempt to estimate real-time stock levels. Inventories also define how long a market can sustain imbalance. A commodity with 100 days of forward cover can withstand supply shocks far better than one with 20 days. The tighter the cover, the higher the sensitivity to news, weather, and geopolitical developments. Inventories are the foundation of commodity price formation. They tell you whether a market is tight or comfortable, whether risks are rising or fading, and whether prices are likely to respond sharply or gradually to new information. For traders, analysts, and supply chain managers, understanding inventories isn't just helpful, it's essential.